on-chain analysis actually is. Oh, good. Okay, so I got a room I can work with. So, you know, he mentioned chain analysis. There are different fields of on-chain analytics. The field that I'm going to be talking about is the one that you should be looking at. Chain analysis is where they go down the path of more forensics, and they're actually looking at individuals, you know, more government contracts, things like that. With on-chain analysis, what we're really looking at Glassnode and within this field, we have the Bitcoin network, we have the asset, we have the payments network, and we have all of the UTXOs and the transactions that take place. And within that, the way I like to describe it, imagine if you could look at and see all of the money moving around the SWIFT system. Would there be some kind of trading edge? Would there be some kind of market edge? What if you could also see the amount of profit, loss, value? You can start to really gauge the economics of the Bitcoin network. So in many ways, on-chain analysis is about the economics of Bitcoin, understanding the macro flows of funds. So what we're going to be looking at today is finding cycle flaws. And I really want to explore this from the angle of psychology, human psychology. Essentially, we are all imprinting some kind of impact on the Bitcoin ledger, and we're going to use that information to actually find out what a bear market flaw really looks like. So flaws are set by sat stackers. Only the hodlers remain. At the end of a bear market, there is absolutely nobody left. The speculators are gone, and only the people who are the most hardcore and understand what Bitcoin is here for are going to remain. There is a certain psychological threshold people can reach. You can only see so much red in your portfolio, particularly in your first cycle, before you just puke out your coins and you've had enough. There are characteristics, there's an imprint or a footprint that we leave when you actually move and sell your coins. And when people have bought the top and sold at the exact bottom, this leaves an imprint. So looking at the characteristics of capitulation, and then we'll bring it all together so we can really see what does a bear market flaw really look like. So what is on-chain analysis? I mentioned before it is very much about economics, and more importantly, it's about behavioral economics. We all make a decision when we sign a private key, when we put a hash onto the network. That is a very conscious decision with a transaction fee, with an energy cost. There is a price to making an imprint on the Bitcoin ledger. So we can look at this from a few different angles, but some really simple concepts to start with is on-chain activity. Is the network growing or not? Do we have more people coming in, more transactions? Generally speaking, more is good, less is bad. Supply dynamics. What is the macro flow of coin supplies? Are we seeing coins flowing in and out of exchanges? Are people transacting amongst themselves? Is there a peer-to-peer economy growing up? What is the overall supply? Is it dominated by whales, shrimp, long-term holders, or short-term holders? Now, there's two factors of on-chain analysis that we do not have in traditional finance, and I wish that I'm sure they wish they did. One is tracking holding times. So in aggregate, we can see when coins are very old. I don't really care that some guy who bought his coin yesterday sold it today. Who cares? What I do care about is when all the people in this room have held your coins for 5 years, when you start spending en masse, that's information that I want to know about. So we can track the holding times. Someone mentioned before the concept of coin days destroyed. We're looking at the holding time, the investor holding time that is being flushed out of the market. And then we have sentiment and capital, which is looking at really the profit and loss. We can measure the time between when a coin was acquired and spent, and we can find the price delta. How much value did someone take out in profit or loss? Now, the reason why all of this works is that the asset can change, the market can change, J-Pal's mood can change, the interest rates can change, all of this changes. What doesn't change is the ape brain that we all have and the response factor we have to fear and greed. And Bitcoin's one of these wonderful assets that with the bubbles and the crashes that it has, it generates plenty of fear and greed. And we're basically leaving a footprint of this on-chain. So I'm just going to take you through a couple of different charts to describe what a bear market flaw really looks like. This one here is called the accumulation trend score. In short, what we're looking at is over the last month, the last 30 days, have on-chain wallets increased their holdings or decreased? The purple zones are essentially where lots of people are buying and adding to their balance. You can see there's kind of two periods of time where people do this, at the top and at the bottom. Why? At the top, you've got a bunch of people who are brand new. They've seen it on the news, their friends getting rich, get me into this thing, I'm missing out. That was me in 2018. I'm sure there's plenty of you here in 2022. You can also see at the very final capitulation in 2018, you can see March 2020, and you can see the June sell-off, which in my view is when the bear market started to form that base, and FTX. And these events are a psychological change. The human behavior pattern switched at those points in time, at tops and at bottoms. Something about the market changed the behavior pattern. This here is the HODL waves. What we're looking at is, what this does is breaks down the entire coin supply into age bands. 1 day old, 1 week old, a month, a year. This one here is looking at all coins that are younger than 3 months. So by contrary, that's the inverse of that is all coins that are older than 3 months. Now you can see near bear market floors, we have an all-time low in young coins, which by proxy means we have an all-time high in old coins. If lots of people are, I mentioned that hodlers set the floor. This is literally showing the gradual, slow, patient, unrelenting buy power of hodlers, just taking coins off the market as price goes down, just continuing to put them in cold storage until eventually there's no one left to sell. So these lows are basically showing that we have got an all-time low in young coins, which by proxy means we have a very saturated market of hodlers. Now, one of the more useful tools is the concept of a realized price. What is the average acquisition price of a particular cohort of investors? The other way to think about this is looking at the kind of the wealth held by coins that are older than 2 years, older than 1 year, and older than 6 months. So essentially, this is kind of like the gravity of people who've held their coins for at least 6 months through the entire shit show that was 2022, right? Complete mess. If you held onto those coins, you're essentially reflected in everything under that level. So this is essentially showing people who weathered the volatility and didn't spend. As soon as you spend your coins, you leave these supply. So this is kind of like a bedrock of people who've stuck around for at least 6 months or, more correctly, 1 year. It really does tend to intersect at bear market floors. You've reached the point where only the strong remain. There's no one left. Now, of those strong, I'm sure many of you, if you were there for the previous cycle, I know I've got some UTXOs from up at 50,000. What this chart is showing is the unrealized profit in green and loss in red. We look at all the coins in the supply. As soon as you spend it, you will get revalued to that price. So imagine where you bought your UTXO. If you're underwater by 30%, you're going to be in the red. If you're up, you're going to be in the green. You can see that the red zone gets pretty much down to the same horizontal level every time. Now, because this is in a relative, it's a percentage of supply, what you're looking at is that point in previous cycles where every single person who is even thinking about selling has seen enough red in their portfolio that they finally cave in and go, I need to get out, I'm done. So you're looking for that pain threshold that just flushes everyone out. Now you can also see that when you get to peaks at the top, everyone's in profit and you have the exact same but in the reverse. So hopefully next year we'll be talking about that problem. Same concept. So the MV/RV ratio is essentially looking at the all cost basis. What is look at the entire coin supply. What is the average price where it transacted? We then take the ratio between the market value, spot price, and the realized value, the acquisition price. So what this oscillator is showing you is the unrealized profit or loss. How much wealth is held above or below the cost basis across the whole market. Now, this is just really simple statistics. The blue line is the all-time average, right? Just show me the middle. You'll often see when you're looking at economics and, traditional finance analysts, give me plus or minus 1 standard deviation. Show me some time where an oscillator or an economic indicator is statistically out of bounds. Plus or minus 1 standard deviation is not a bad trick to just find out when the market is in just enough pain to flush out at the bottom and too much profit that they're going to start selling and oversupplying at the top. So here you can see we've essentially gone down to that -1 standard deviation, which from a probability standpoint is an improbable place to be. The other way you can measure this is say how many days have we been lower than this level? And these levels we're talking about below the green line, you're talking about 5% of Bitcoin's trading history. So that means if there's 5% below, the gravity is actually upwards. You've got 95%. It wants to be less down than what that currently is. So what we were talking about before is about supply and the unrealized profit and loss. It's kind of look at all the coin supply, how much wealth is held in it, how much profit and loss is held within it. But at some point, someone's going to sell. Someone's going to spend their coins. Someone's going to capitulate out. In order to create the bottom, this is the realized component, the actual spending behavior. So this is a ratio between the amount of profit and loss. If you acquired your coin at $10,000 and you spend it at $50,000, then you've essentially had a $40,000 gain times whatever the coin volume is. Likewise, if you were the poor bloke who bought it at 50,000, you're selling at 15, you're going to be in an unrealized loss, in a realized loss. So we just take a very simple ratio between the two. How much profit is in the system? As you can probably imagine, there's a lot of it in bulls, and it's pretty nasty down near the bottom. But the thing that's quite interesting, look at exactly what happens when this thing gets down to an absolute peak loss. Talk about selling the exact wrong time. People do it every single cycle without fail. And this is actually telling you two things. One, the people who are in profit are not spending because that would push the ratio higher, which means the guys from the previous bear, they're done selling as well. The only people who are selling at this point in time with FTX at the bottom of 2018 and in 2015, it's the final flush out. The top buyers, get me out of this asset. This is a very similar concept. The metric before is more on a dollar value basis. It's going to capture the effects of a whale will have a larger impact than a shrimp. This metric's called SOPA. It's the same concept, but it doesn't matter how much coin you have. This is an equal playing field. Shrimp have the same weight as whales. So it's a nice way to then reevaluate the entire market. We've got the same thing here with an all-time average and then plus or minus 1 sigma. Now, we released a report, I think it was week 46. We do a newsletter every single week called The Week on Chain. That point that we had, the final line of that particular report said, I can't remember the exact wording, but it was the point of absolute seller exhaustion. In every prior event where we've seen all of these characteristics in play, it was the point of absolute seller exhaustion. And here we are with FTX, with the largest out-of-bound, most negatively deviated SOPA reading. Talk about a capitulation. We saw people from the highest level all the way up through the 2022 cycle puking at the exact same time. Now, we also have the production side of the equation. You'll often see things like the hash ribbons, various hash rate metrics. Miners are the production side of Bitcoin. Now, this is a combined model. The orange curve is what we call the Puell multiple, named after my good friend David Puell, who invented it, and he's exactly the kind of guy who put his name on a metric. So the Puell multiple maps the miner revenue, how much money are they making today, versus their one-year average, right? It's just a really simple metric. We use this concept quite a bit. In fact, we call it Puellification in honor of his name. So what we're looking for is, are miners making a stack less money than they have been recently? Because that's an implied stress. We're assuming that when they're earning less than what they were a year ago, then they're probably going to be under stress. In the background in purple is what we call the difficulty ribbon compression. So we're saying, okay, they are experiencing income stress. We're implying we believe that miners are under stress. But then you also start seeing hash rate coming offline, difficulty winding back. As a miner, you don't turn off your hash rate unless you absolutely have to, because that is losing money. So when we see both of these things fire off at the same time, we imply that miners are under stress, and then we actually see difficulty coming off and mining turning off. Then we start to say, right, miners are also. Now, the thing with miners is they are pro-cyclical. For whatever reason, they lever up at the top and they puke their coins out of the bottom. It is a cycle that we expected to break. Alas, we didn't see it. I think that will eventually break, but we didn't see it last cycle. So kind of bringing this whole thing together. Obviously, there's a lot of concepts, and the thing with on-chain analysis, like all arts, like all disciplines, like all analysis forms, there is a degree of proof of work. If you come in and you look at one metric and you say you don't get it, well, you're probably not going to get it from there on. The point is to actually learn more about these things and put these topics together. But because this is there's a lot of metrics, there's a lot of tools, a lot of concepts, we've tried distilling these ideas into a single kind of usable starting point. For some people, something like this is going to be enough. We've got 4 color bands here. You'll see there's a red one, a blue one, a yellow one, and a green one, and they go positive or negative. Essentially what we're looking at is, in the green, are enough people holding onto their coins at an unrealized loss? That's the hodlers, right? Are we at a point where the amount of unrealized loss in the system has been sufficient to shake out all sellers in the past? In the yellow, we're looking at SOPA. Have we actually flushed out people? Have we actually seen that capitulation event happen? In the blue, we have the Puell multiple. Do we actually have miners who are severely underwater? And then we have the red, which is the reserve risk, which do we actually have the amount of hodling? Do we have that concentration of wealth with people who know what Bitcoin is about? And this thing will basically fire off at the top when you've got the exact inverse, or fire off at the bottom when you've got all these conditions. You've got confluence across all of them. So what does a bear market floor look like? You've got investor accumulation shifts. the behavior pattern changes. We see something happen. When that sell-off happens, people go, you know what, that looks like value. Your price reaches down to the hodler bedrock. It's kind of like coming back to gravity, back down to the cost of production, back down to the fair value where people are saying, I will buy this thing, rain, hail, or shine. That's the value you're looking for. Do we have enough unrealized pain in the market? The hodlers will hang on to that red. A lot of people will not. So do we have enough pain in the market that shakes out people in all previous cycles? Have we actually seen that capitulation happen? Have we seen those people get flushed out? And add in a bit of statistics just for a bit of rigor. Do we actually have a bunch of things that are outside their normal trading range by some margin? So that's really the crux of finding a Bitcoin. I mean, again, these things kind of, it will evolve and change. These models do tweak, right? But generally speaking, the human ape brain is exactly the same. And the beautiful thing here is that we can track this time and time again, cycle after cycle on the Bitcoin ledger. Now, if you are interested in learning a bit more, we have a YouTube channel that we put out a video every single week. We try to cover these topics, and it is a long process, right? And there's been people who kind of been watching these videos for many months, and slowly but surely these concepts start to make sense. So really, on-chain analysis is a new discipline. It gives people access to information that traditional finance analysts wish they had, and here we can essentially extract it from the blockchain, turn it into information, and really understand the heartbeat of what Bitcoin's doing. And that's it.